Happy St. Patrick's, everybody. Let's get right to this. So, mortgages have continued to improve this week. So, last week, mortgage rates started coming down, and the improvement has continued this week. Not as much as we might have hoped for, with the treasury yields coming down as much as they have, but mortgages are a little bit underperforming. I'm going to bring on Dan Habib with MBS Highway to help explain some of what's going on in the banking world right now. Dan, come on and tell us what you know.
Good morning and happy St. Patrick's Day. Right now, you see mortgage-backed securities. They are in the green. They're up 14 basis points. 10-year down 10 basis points to 347. But they have been vacillating between big ups and also pairing some of those gains. And there's more news today in the banking sector. When you take a look at Silicon Valley Bank, their holding company, Silicon Valley Financial, they just filed for bankruptcy. And when you take a look at First Republic Bank, this is a bank out there that was getting heavily shorted because many traders out there are keen to some of the weaknesses within that bank. Where you take a look, much of their deposits were uninsured. So it was thought that there was a big risk of a run on this bank. So what did the Fed do? Well, instead of bailing them out themselves, they coerced 11 of the largest banks in the United States to deposit about $30 billion at that bank to shore up confidence and liquidity. Now, the terms here is that they have to keep the money there for at least 120 days, but this certainly raises some questions. Now, no question, this is a Band-Aid that's working for now, but what happens after the 120 days? What happens if at that point customers see this and want to take their deposits out? It's unclear. And why aren't they able to maybe find a buyer out there of the bank or some of their assets? It certainly seems that there's maybe some deeper weakness that hasn't been brought to the surface yet. Now, when we take a look at this example, it's pretty weird and unprecedented. This would be, and this is a hat tip to Peter Bookvar, but this would be like the Fed saying to Target, Costco, Walmart, hey, one of the retailers out there is not doing so well, so we need you to go ahead and buy some of their goods to keep them alive for now. But this brings us to the Fed, and we know that the big item of next week is going to be the Fed meeting. And the Fed, what they've been trying to do over the last several months is reduce their massive balance sheet. They amassed a $7 trillion plus balance sheet through all of their quantitative easing, all of their buying of mortgage-backed securities and treasuries. But they've been doing something now called quantitative tightening, where they've been allowing up to $95 billion a month of the mortgage-backed securities and treasuries and holdings that they have to roll off each month. And they've been making some progress, but guess what? Just over the last week, their balance sheet has increased by about $300 billion. So this is banks and people coming to the liquidity window, to the discount window, the new bank term funding program that they've opened up, people needing that liquidity. It's unclear how much of this is real needs for liquidity or maybe just in case. But this is certainly something that is undoing about 4 months of progress of quantitative tightening from the Fed. Now, what are they going to do at their meeting next week? This is the big question. Now, if they follow the ECB, which simply didn't care about the banking crisis and said, you know what, we're going to hike 50 basis points anyway, is the Fed going to follow that lead? Well, knowing our Fed, even though we believe they should pause, they've already gone at an unprecedented rate. Wait to see how this settles out. Don't apply more pressure to the banking system. Knowing them, they'll probably go ahead and hike 25 basis points, and maybe they'll use Fed Chair Powell's commentary and the press conference to try to quell the markets and maybe signal that, hey, this is going to be the last hike that we get in, and we're going to pause from here. We'll have to wait and see, but this is certainly something that's going to create a volatile week next week. Now, Diana, we have some other important items coming out as well.
That's right. Not only is it your birthday on Wednesday, so let's hope Powell gifts us with some good answers to the question and answer session on Wednesday, but we also have existing and new home sales coming out, and existing home sales is trying to inch towards being positive again. So let's see what kind of strength we see there, and we'll keep a close eye out on new home sales as well.
Yeah, Diana, I'm going to be interested to see that, because if you look at the last few months of pending home sales, they were positive. And, remember, pending home sales signed contracts in that month. So we've been seeing the last 2 months of some positive jumps. That means that, hey, if you sign the contract, maybe 30 to 60 days later, you're going to be closing on that home, which will show up in existing home sales. So maybe we will see a positive pop there, even though rates did move up in February. Now, let's take a quick look at the charts here, team, because there's some interesting developments here. You can see mortgage-backed securities, they're up 17 basis points. And as we mentioned in the bump, really since March 13th, you haven't seen much progress. You've certainly seen a ton of volatility, unable to really break and stay above this 50% Fibonacci level here. And right now you can see we're contending with the 50-day moving average. Bonds have also quickly gotten up here into oversold territory, so we have to be on guard. And when you take a look at the 10-year, I believe this is going to be the real test. You can see the 10-year has not been able to really close convincingly beneath this 200-day moving average. And we want to see this thing break on through to the other side. Now, a couple things that are working in our favor, and hat tip to David Rosenberg for this, is that there is a massive amount of shorts on the 10-year for this month of March. And what that means is that they shorted the price. So the way that they would go ahead and cover that is by buying 10 years. If it goes away from them, they're underwater and they have to cover. Well, that means you have a massive potential amount of people buying 10-year treasury notes, which can drive the yield lower and potentially beneath this 200-day moving average, which would, of course, correspond to mortgage-backed securities moving higher, as they are pretty closely correlated. Now, being that it is St. Patrick's Day, we hope that the candle will close in the green, but we will begin the day here after locking 4 out of the last 5 days through this volatility, trying to capture some of this best pricing for your customers. We can begin the day here carefully floating.
Good news is mortgage rates aren't rising. They're not going up. If you want to schedule a one-on-one appointment with me, Jerry DeMaio, go to www.mortgage-zoom.com for your one-on-one appointment with me, Jerry DeMaio. We'll have a Zoom appointment, and I can help guide you and your family to what works best for you. Please don't forget, subscribe to my channel. Please don't forget to like this video. Thanks, everybody. Have a great day.